Good morning. Welcome, everyone. Thank you for joining us. Without further ado, it is my pleasure to introduce Thomas Hayes. He's the founder, chairman, and managing member of Great Hill Capital. To our live viewers, if you have any questions for Thomas, please put them in the chat box. Time permitting, we will get to those at the end of his presentation. And with that said, Thomas, I'll be right here if you need anything, and the floor is all yours.
Thanks so much, and welcome everyone to the Money Show. Very excited to be here. As you can see, our presentation is called Turnaround Tom's Top Picks and Outlook for 2024. And I got that nickname because I really like to be in companies that are high quality companies that have durable advantages, but are meaningfully out of favor with some catalysts to turn around. So I've gained that nickname over the years, and I think you're going to see why as we go through the presentation. But a little bit about my background first, because you not only want to listen to my opinion, but actually know why it may or may not make sense to listen to the speaker's opinion. I do have over a decade and a half in the hedge fund world and in the hedge fund business. I'm a long-short equity manager. We focus on quality value as kind of our knitting. You can see me regularly on Fox Business, some of the CNBC stations, Yahoo Finance, BBC, et cetera. Prior to starting my own firm with Great Hill Capital, I was with a firm that many of you may know called Cornwall Capital. They were featured in the movie The Big Short. I worked for the gentleman that is played by Brad Pitt. He's known as Ben Rickett in the movie. I would say he is much smarter in person and not quite as handsome as Brad Pitt. And I think he would agree with both of those assessments. And then prior to that, the first hedge fund I was at, Bedford Oak Advisors, we had a portfolio company that I was actually inserted as the chief operating officer of the public company. And my job was to go in, sell off the non-core assets, and then use that cash to source, negotiate, and close the purchase of an asset management firm. And what was valuable about that was I interviewed over 100 different firms, and I got to see which strategies worked, which were durable, which stood the test of time, and ultimately sourced, negotiated, and closed the purchase of an asset manager with over 1.6 billion under management. So got a lot of experience with that. And then attended Columbia University. Now, Great Hill Capital runs a long-short equity strategy in separately managed account format for accredited investors and qualified institutions. We have developed a reputation over time for benefiting from sector, stock, and general market dislocations and periods of distress. And you're going to see with some of the names we present today that we definitely like distress. We also do a weekly podcast video cast for free, which is top rated in the hedge fund category. It's been toggling back and forth between the #1 and #2 spot for feed spot. We've been going for about 3 or 4 years with that, 222 episodes now. The podcast is called Hedge Fund Tips with Tom Hayes. And over time, that's how we've got quite a few of our clients that weren't referrals from friends or existing clients. They listen for, several months or a year or more in some cases. They make money off the ideas, and then they're like, here, you manage it. And we like that strategy. So I think you'll get a lot of value whether you become a client or you don't. Our strategy simplified. We make our money buying on weakness and selling on strength. That's easier said than done. A lot of people like to buy on strength what's already up. I think over time, you'll see over decades that the idea of buying when things are out of favor will outperform. And then you'll get some short periods where buying momentum actually works better when money is free and rates are low. But as we see a rate normalization, this strategy has started to really come to the forefront, and stock pickers are doing exceptionally well. Our confidence to step in when others are bailing is rooted in deep research and the premise that the more price becomes dislocated, the more risk that has actually come out. What is the first thing you hear people say when a stock is down? Oh, that stock is falling. That's really risky. Well, no, it was probably risky when it was trading at 2 standard deviations above its historic multiple, and everyone was chasing the last few ticks. Actually, when you have a business that is down, but cash flow is stable, growing, durable for a high quality business, those are generational opportunities. And finally, most participants see increased volatility as increased risk. We view it as increased opportunity. So we hope that we can impart that kind of framework to you today, and hopefully that will add some value to your investing process. We didn't invent anything. We just copied the best in the world. Warren Buffett has had an enormous influence, obviously, with Charlie Munger, and then Buffett's mentor, Ben Graham and Dodd. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. And I think the key here is excellent companies are surrounded. Some people just buy stuff because it's way up or because it's way down, and it takes no consideration as to, well, is it generating free cash flow? Is that free cash flow growing? Or is it declining? Why? Is it a temporary impairment? Is it a permanent impairment? What is the solvency risk? How does the balance sheet look? And these are important questions before stepping into something just because it's down a lot or just because it's up a lot. And we'll get into that today as well. But first, let's get to the big picture, because everyone always wants to know, is the market going to go up or down? And the answer is, I can't tell you what's going to happen in the next 2 days or the next 2 weeks or the next 2 months. So don't log out. But I can give you some ideas of how we think about the next few years and the greatest opportunities there, and particularly in 2024. But this is a framework from Robert Slumer that we started talking about in 2020 before he published this beautiful graphic that coincides with exactly the way that we're thinking about where we are in the long-term secular cycle. And what the case that Robert makes here from RBC is that the generational cycles last on average about 16 to 18 years. It's driven by demographics. And if you go throughout history, the countries and economies that do exceptionally well tend to have a large portion of their population age 32, 33, all the way up to 40. And by the time that bulk of the population hits 40, their consumption starts to decline. And if you think about housing and family formation, you move out to the suburbs, you buy the house, you buy the car, you buy the stroller, you buy the crib, you buy the washing machine, you buy the refrigerator, you buy the extra car. And that's what happens in these periods here of reflation and beyond. And then these periods here, like most recently, we had basically a lost decade and a half in the 2000s after the 2000 peak. Part of the reason for that is my generation, Generation X, you went from 80 million baby boomers getting up, over 40 in 2000 to drop down to 65 million Generation X, which was a very small generation. And that's why the Fed was able to print so much money over that period and not create inflation, because the demand was so low from such a small population in their 30s and 40s starting housing and family formation. And now we have the millennials reaccelerating, average age 33, 34, and Gen Z behind them, which gives us runway for another 10 years. And we think dips are to be bought from now through early 2030s. And that doesn't mean we won't have normal, the average drawdown each year is 14%. So normal 8 to 10% pullbacks, some 20% corrections along the way. But the general secular trend is up until the millennials and some of the older Gen Z start to turn 40 and the consumption slows and we move more into a sideways period like we saw in the 30s and 40s, in the late 60s to the late 70s, and in the 2000 to 2015. So kind of stepping back and looking at where we are in that cycle. The other thing to keep in mind, a lot of people are saying, like, we have to correct and have a big crash now because we had such a big run the last 9 weeks of 2023. But if you step back and look in perspective, we have had 0 stock market gains for the last 2 years. You can see that we peaked out in late 2021 and we're just now starting to break out to new highs. What you can see here historically is after you've had big rallies off of hard lows like we had in October 2022, when many people were saying stay out of the stock market. We had a huge rally here, and while we have moved a long way, like all of these other 2-year consolidations off of big rallies, the 2009 rally, when they break out, yes, they can check back and retest. Yes, they can check back and retest, check back and retest. But they tend to proceed multi-year durable rallies for 1 to 2 years following the breakout. The exception would be the 2009 breakout only lasted about 6 months and went about 25%. And then we had COVID. So if you are betting on another once in 100-year black swan, then I guess you wouldn't want to be constructive here. But if you're betting that 90, it's going to be more like 99 out of the last 100 instances of 12-month periods, then, breakouts are generally bullish, and you want to be selective and buy those quality companies that maybe didn't participate quite as much in the last 9 months or off the 2020 lows. So obviously you had major tech outperformance, FANG outperformance. We think they continue to perform, but maybe more in line with the indices. And what do we think about the indices for this year? Well, we know it is an election year. And since 1928, election years on average are up 11.28%. We would expect to see high single digit, low double digit growth in the general indices, and a lot more opportunity and a lot more upside under the surface, particularly in maybe those names that didn't have all of the outperformance over the last 16 or 18 months, which would be non-FANG. FANG, by definition, if the indices are up, call it 10%, FANG will have a decent year. The Magnificent Seven will have a decent year, high single digits, low double digits. But the real outperformance can come under the surface from the things that have not outperformed. Now, where are we in the process? This is a great chart from Fundstrat that lays out the composite performance in an election year since 1950, which would be the gray line, which shows a lot of sideways chop for the first 3 months of the year, a little pullback in March, and then you grind higher to those high single-digit returns by the end of the year with a little weakness right before the election in the latter part of the year. However, in those years where the stock market is up 10% the year before the election, you get a little bit more outsized performance straight out of the gate and for the whole year. So the composite would imply the S&P actually does push through beyond new highs and brings a number of skeptical people in that missed the 9-week rally, brings them into late January, early February. And then we get that normal weakness in March that you would get any election year followed through. Now, none of these are cast in stone. Anything can happen, but all we do in the business is play probabilities. And in terms of the type of business we invest in, and I say invest in, don't trade in, we have a 12 to 36 month plus time horizon on what we're looking for, because we're looking for outsized gains, and you just generally don't get that inside the 12-month period. And plus, we want to be tax efficient for our clients as well. And then finally, this is from All Star Charts. This is just the 4-year general composite over time. And as you can see, the second year is weak, which we had in 2022. The third year is strong, which we had last year. And then the fourth year is also an up year. You can see here it starts off a little choppy. Again, a little weakness in March and April, followed by single digit to high double digit years. So we're very constructive for January 2024. As I said, I can't tell you what's going to happen in the next 2 days, 2 weeks, or 2 months. It could be sideways chop. We could go a lot higher, draw people in, and then maybe get a little more defensive into March. But on balance, if you just close your eyes and come back at the end of the year, I think we're going to be up in a nice way, and it should be a decent year. This is also confirmed by this data from for the Dow Jones since 1987, from 1897, over 120 years, showing the average returns per year in a decade. So The second year tends to be the weakest. Then the third year starts to rebound like we saw last year. Fourth year is a little sideways chop, finishing up stronger. And then the fifth and sixth year are on average the biggest years. So we could be in line for what we talked about, which is after you break out of these, the rallies tend to last for a couple of years on average, unless you get a once in 100-year event, black swan. And I think that's kind of where we are. And that coincides well and syncs well with the pattern over the last 120 years. And then you look at earnings. Obviously, earnings have been sideways for the last 3 years. They're going to jump up. We're looking at 12% earnings growth for 2024. And a lot of that reason is managements were preparing for a recession in 2023 that already came in 2022. So everyone's waiting for a recession that already came in the first quarter, 2 quarters of 2022. If you go back and look, we did have a technical recession of 2 consecutive negative quarters of GDP. And for everyone saying, well, look at the yield curve. Every time the yield curve inverts, we get a recession. But if you go back a little bit further, all the way, talk about a mid-cycle, 1995, but the better comp would be 1980 to 1982, when you had an inversion that led to the first correction, just like we had in 2020. And then you had a second inversion. And after that second inversion, 1982, the Fed shifted from an aggressive hiking cycle like we just had to an easing cycle, and it actually set off an 18-year bull market. So while everyone was looking for the second recession in 1982, and some prominent names really got that publicly aggressively wrong, the opposite actually happened, and it actually birthed a record secular bull market for the next 18 years. I don't think we have 18 years because I think we're mid-cycle, as we discussed earlier, but I do think we have very good things ahead for some time. Dry powder and interest expense, you've seen this, money market fund assets. Now, the bears will say that this is just because the banks aren't paying proper interest on deposits, and therefore everything's moving to the money markets, and that's just going to be permanent money because it's just what was deposit money is now money market money. But one of the things I said in the podcast early last year when everyone was pounding the table, why would you take equity risk when you can get 5% doing nothing? And what I said in my podcast regularly to my viewers was, we look for the max pain trade. So the max pain is the context is what move in the market would cause the most amount of pain to the most amount of people at any one point in time. And when everyone was crowding into 5%, well, if the market went down, they won. If the market went flat, they won. So the only thing that could cause pain to everyone that was crowding into 5% would be that the stock market does a whole lot better than 5% and they miss it. And that's exactly what happened in 2024 with the S&P up well over 20%. All the people that were in 5% lost 15% that they'll never get back. So where is the max pain right now? What we're seeing is, yes, we're starting to see a little euphoria. So we could have some bumpiness in the first quarter. Maybe we'll push a few more people in, convert all the pessimists in late January and early February before we finally get a nice 5 or 10% pullback in March, April, and then resume the uptrend. But this money, this $6 trillion, as rates come down, and this is no longer 5%, it becomes 4%, et cetera, and the stock market performs, I think you're going to see a lot more of this get forced into the markets over time. And that would be the fodder for 1 to 2 year rally after the breakout, which would be consistent after 2 years of no gains and sideways consolidation. The other aspect that you want to keep in mind is balance sheets, both for the individual debt service as a percentage of income and for corporations, corporate interest expense as a percentage of profits are near all-time lows. You have to go all the way back to World War II to find the interest expense for corporations at a lower rate as a percentage of profits. The final bear argument, money supply contraction. M2 money supply hasn't contracted this much since since the Great Depression. Therefore, we're going to have a Great Depression. That was a common theme last year until the stock market went up 25%, and then they all flipped. And some of them still haven't flipped. So what you're seeing here, though, if you put it into context, is we had an aberrational period. So while we've had money supply contraction, it still ran $4 trillion above the normal trend. And this is very, very important to understand, is that it's going to take several years to work off this excess money supply. All the money that was put in the system, monetary policy, now fiscal policy with the IRA, there's going to be a lot of money put into the economy this year, left over from the IRA. So you can see here, just to get back to trend, we're going to have to contract a lot more. And that is still a bullish trend of increased money supply. This kind of shows the different frames from that long-term secular. If we are to follow the bull market from 82 to 2000, you can see how we're tracking here, and it could go straight up. If we're to follow the more subdued version from the 48 to 1968, you can see we still have a lot of runway. My guess is it'll be somewhere in between, but the Slumer model is implying that off the lows, each of the previous secular bulls was 2,300%. And if we got a similar return of 2,000 plus, that would put the S&P 500 at 13,500 to 14,000 by 2034. Look, it's never that easy, but I think in the context of most people being bearish for the last year and a half and keeping a lot of people out of the market, I think it's important to keep in mind that while the 9 weeks rally looks like a lot, it's this tiny little line here, and we're just now breaking out. So let's get to some exciting stocks, turnaround stocks that I like to talk about. As you can see, look at PayPal. The stock is down 80%. Okay, so you would think, oh my goodness, their revenues must be crashing, their cash flow ability to generate cash, maybe they have balance sheet issues that they're going to go bankrupt. I mean, what kind of stock drops 80%? Well, I don't know. Let's take a look. The stock historically traded at a 30 PE multiple. It's now trading at about 12 times forward earnings. And you can see here that the revenues per share since 2015 have gone from $7.56 per share now up to, call it 28. So they've gone up 400%. The cash flow per share has gone from about $1.50 a share to 5. So 200% gains, or 3x. And the earnings per share have gone from about $1 to, call it $4. So 300% or 4x. And yet the price is basically the same. Now, this business is a consistent double-digit compounder of capital. Its return on invested capital is high. So what has caused the stock to fall from $310 down to $60? And that is, there is a fear about declining margins and increased competition. The solution, the new CEO is Alex Chris. He came from Intuit. We want to bet on this new jockey. He just started in late September, early October. He ran the small business division at Intuit, which was 50% of the revenues during 2008 to 2023, when the company actually was a 38 bagger. So he was responsible for 50% of the growth, part through organic, part through accretive acquisitions, which he's going to do with PayPal as well. Stock went from $18 to $7.07. He is committed to turning PayPal back into a growth company. Right now, it's trading like a value company. He wants to reaccelerate growth. And PayPal generated $5.2 billion of free cash flow in the last 12 months. So it's not a solvency issue. It's not a declining in earnings. It's not a declining in anything. It's just a decline in multiple on the fear of margin contraction from the Braintree business. I'm going to talk about that. The Braintree margins are stabilizing. He said in the last call he expects an inflection in Q4, which we're going to hear in coming weeks, which will be a huge boon to the stock. This is the path to 150 in our view. Again, not in 2 days or months, but we take a 1 to 3 year plus view on all of our positions. They have started firing all the unprofitable customers in Latin America. If they have customers that they're not making money, they're just closing their accounts and focused on profitable growth to get the growth multiple back as these margins start to inflect. They've got $428 million accounts, 10% enterprise of the global enterprise business. That's the Braintree white label stuff. It's not the PayPal branded stuff. It's the white label stuff. So it's $5 trillion business abroad. They've got 400 to 500 billion. Think about Uber. They have Ticketmaster, they have Adobe, they have Booking.com, those type of business. And that's where he said the margins are going to inflect. And that's what the analysts have been worried about previously before he came in. So once they see a light at the end of the tunnel, that multiple is going to get re-rated. Their total payment volume was up 15% year on year. Last quarter, revenues were up 8%. And they did $5 billion of buybacks in 2023. That's going to continue. They also have this PayPal USD stablecoin opportunity for the crypto crowd. And buy now, pay later, they are a leader in that group. Venmo is a verb like Kleenex, FedEx, Uber, etc. And the focus on profitable growth, cut expenses, implement efficiencies. Disney is our second turnaround, Tom, pick of the week. History doesn't rhyme, but it does repeat. There are two major oil families in Texas. One is the Bass family, and they put $300 million in cash and in kind for a 25% stake in Disney 1984. It was a very similar situation. The parks were stale, the legacy IP, the classic movies were underutilized. They hit a slump in creativity, and their media business was struggling. Does that sound familiar? Well, what did they do? They appointed Michael Eisner. Okay, so we got Iger back. We're also going to have further succession in the next 2 years. And the turnaround was the big thing. The new technology was the VHS tapes that you put in a VCR. Most of you won't even know what a VCR is, but it was this rectangular black thing with tape. It looked like a cassette tape. You probably won't know what that is either. But you put it in a box and it plays the movie. So they took all this old content library and put it in these black squares, and they made billions on those black things for the next 20 years. The VHS tapes, old content, new technology. That is the theme. And that's exactly what we have now with streaming, which we're going to talk a little bit about here. They hired Jeffrey Katzenberg to resuscitate Disney animation. Out of that, they got The Lion King and Beauty and the Beast. They expanded hotels and theme parks internationally, Hong Kong and Paris, and they 4x profits over the next 10 years. That $300 million became worth as much as $5.8 billion over, by the late 1990s. And now we have a similar situation where the stock has been consolidating for a lot of years. It's down 60% right now off of its recent high. And you have a new activist in Value Act and also in Trian Partners that are going to catalyze these changes, just like the Bass family did in 1984. So they're investing $60 billion in parks because it has the highest return on invested capital over any of their other businesses over the next decade. Their parks and their consumer products has $10 billion of EBIT. We believe that's worth about $80 a share, which is basically where the stock is trading right now. But the implication of that is that all of the other parts of the business, theatrical movies, ESPN, which has the #1 share in sports and growing, Disney Plus, Hulu, TV networks, are worth zero. We think they're worth a lot more than zero, and we think this can work its way back up into the mid to high 100s over the next few years, and maybe to new highs. That's a huge upside. So they're well ahead on the cost cuts. They're actually now cutting $2 billion more than they had originally planned to, and they are focused on quality versus quantity. And finally, my last idea is Alibaba. This is the one that is causing half of the viewers to lean over to find a garbage can and try not to do their business from a sick stomach after hearing this. This has been dead money for over a year and a half. It has gone nowhere. It bottomed in early 2022. We're now in 2024. We're retesting those lows. And but again, we are now, you're able to buy this stock at the same price it was at when it IPO'd in 2014. The difference is Since that time, the revenues have grown by 884% per share. The cash flow per share has grown by 500%. The earnings per share, 500%. So what's the problem? Similar to PayPal, which had historically traded as high as 30 times multiple and now is trading at 12 times forward. Baba's trading at about 7.5 times multiple because of the geopolitical risk. Everyone says Xi is terrible, except for the fact Xi was also in power when the stock was at $310. So bottom line is the patient had a heart attack. You had the shutdown, lockdown that was more severe. You didn't have enough stimulus coming out of it. So it's just taking the patient a little bit longer to get back on his feet. But, you know, it will. And people always ask me, what would cause you to sell? And the answer is if cash flow and earnings power started to decline for a few quarters in a row and the business was deteriorating, even though the economy grew 5.2% in 2023, which just announced last night, then we would reevaluate. But that's nowhere in sight. If anything, the opposite has been happening. Cash flows are growing, earnings are growing, the business is growing. And then what will be the catalyst for a re-rating is just as their overall economy accelerates. Microsoft had the exact same problem from 2006 to 2013. The stock went sideways for 7 years. You can see from here to here, but revenues doubled, cash flow was up 200%, earnings more than doubled, the stock did nothing. And then all of a sudden, they had a succession plan. Satya came in and the stock over the next 7 years went up 1,500%, 15 bagger. By the way, the revenues, earnings, and cash flow did not grow that much more under Satya Nadella as a percentage basis than it did under Ballmer. But under Ballmer, the stock went nowhere, despite the fact the business was growing. Under Satya, you got a re-rating of the multiple because you had a new catalyst. And we believe that's going to be the case with cash flow growing PayPal, cash flow growing Baba, and Disney as they complete their turnaround. Now, this is the last piece I want to say. Voting machine in the short term versus the weighing machine. Everyone says foreign purchases of China stocks are at an 8-year low. Therefore, this is a bad time to buy, except the last time they were this low was 2015 when the stock was in the 50s after it crashed from 120. There were no sellers left. And what happened over the next few years? It was a six-bagger, up 500%. Similar type thing. Here is the last piece. Number one is the dividend yield is higher than the bond yields. The last 5 times this happened, the indices were up 57% on average with 100% hit rate. And you can see these 2-year consolidations. Back here, revenues were $6 a share. Cash flow was $3 a share. Earnings was $2.60. Then all of those revenues tripled. The stock went from 50 to 200. Cash flow doubled and earnings doubled. And now revenues are up 10x. Cash flow is up 4x and earnings are up 3x. And here we are at the same prices. It's just a question of time. We finished most of the consolidation. We think we're poised to get a monster rebound, and we're going to see a breakout like we've seen the last 2 times we've had this long a period of consolidation despite improving fundamentals. So in the short term, avoid the emotions and focus on the fundamentals for the weighing machine, and you'll get the results. My podcast, you can find anywhere, Hedge Fund Tips with Tom Hayes. You can find me on Twitter at Hedge Fund Tips, or search YouTube for the video version, Hedge Fund Tips, and you'll see all the channels. There's my contact information. If we have any questions, I'll be happy to take 1 or 2.
Okay, we are a little bit over time, but we did get one question. Will the current massive debt to GDP ratio impact the presidential election cycle positive S&P return pattern?
Perfect question. The last time we had this high debt to GDP was post-World War II at over 120% in 1948. By 1958, that ratio had come down to 63%. How did they do it? They inflated it away. So they ran inflation above trend between 3 to 4% range. Above trend should be 2%. And they were able to inflate it away. And that started and coincided with that 20-year bull market we covered from 1948 to 1968. So yes, we have a lot of debt, but they'll let inflation run a little hotter, 3-4%. We'll inflate that away. We'll get growth. The consumption and the production from the millennials will offset that. and we should be in good stead. That's not to say they don't have to fix things in Washington, but I think we're going to follow a familiar playbook from the 50s and early 60s.